Thanks for being here this month. Don't forget you can check out our guide to monthly charts. If there's anything I go through very quickly, I do a longer explanation of them. If you're watching on YouTube, that'll be in the description. So you can check that out at some time later. All right, I thought this was super fascinating. We're talking about rate depressions, and rate depressions meaning interest rates are falling. And what happens when interest rates are falling? It means the price of bonds are rising. So it's good for bonds. A rate depression is actually a good thing for bonds. But the Bank of England has a chart, and Daily Reckoning showed this, that it went back to 1311. That is a lot of history of interest rates. And that we're kind of in the bottom, it looks like. And there's been a lot of talk about a 40-year cycle that typically happens where that's where it ebbs and flows. And we're at the bottom of that. We should be in a place where rates rise for a good long time, 40 years, but that's bad for bonds going forward. This gives a great example of, this was great for bonds, this was bad for bonds, great for bonds, bad for bonds. And that's gone on. I can't believe there's data back to 1300s. I think that's amazing. So something to think about, but we are in that cycle where bonds are not going to be the diversifier that they were for the past 40 years, which is what most people's investing lives have been up to this point. Long term, we are positive, but we are stretched like we were here, and things kind of get pulled back if it stretches. I mean, it doesn't mean it can't run, but I am a little bit feeling that it's overbought here, and not meaning we couldn't see a market that goes sideways for a little bit and then continues further. Momentum is there, or the money flow is there. That's something we're definitely watching. We're in a good spot that we haven't seen in a year and a half. It's been a while. So it's nice to see positivity creeping back into the market in the form of money flow. As far as the midterm cycle, that is also positive. It's pushing up pretty good. And if it can hold, again, that's something that backs up. But again, we're pushing on the high side. That could stretch, it could pull back, or it could continue like back here. We'd pushed and then paused and continued. And then that was another good little rally before giving back the end of July. That was a good run. And then it got weak after that. So we could see this run continue for another month, another 2 months. Who knows? We're also in the highest probability of a good market cycle of the 4-year presidential cycle. We've talked about this before, where the third year is usually the strongest part, and usually the first quarter of the third year is very strong. So we have a lot of tailwinds behind it. We have a lot behind us saying that we could push higher, and this could stay good for a while. So that's the hope, and we are positioned for that. And as far as right now, we've got 9 positive and 2 negative sectors here. All the usuals. Interesting that the 2 negatives are energy and healthcare. I'm not sure why healthcare looks so weak. It's just been not going anywhere. It's actually been going down on these really nice up move days. And energy has been strong, but it led the way up, and it's again leading the way down again. So I'm not sure where that is in the cycle, but when you look at everything else, positivity has been across the board. It's fairly new. Last time I showed positivity, it was up in the 20 to 30 day range, and that's when things get tired and slow. So I think we've got room to run. And the negative one here is consumer staples. And if that's not doing well, that's fine, because that's a defensive place to be. Our positivities are communications, really a derivative of tech, financials, and industrials. So we've been seeing that theme for a while. The more industrials, the value side being strong over the past year. And it looks like that's going to continue. But we are seeing tech backing up. We're seeing communications. It's a little bit more broad, and even real estate is starting to look interesting. So hopefully that will lift all boats, as they say, with the tide coming in. On the rotation cycle, everything's looking up and to the right, and that's where I want to be. We've been spending a lot of time down here in the last month for December, but this is really what I want to see. Energy is kind of peaking, pushing down, but it's still in the green box, which is nice. Everything else is just pushing up or pushing to the right. So that's improving or leading the market. That's where I want to see things to go. If I want to see the market continue to stay positive. The one thing that's interesting that I'd love to see break through is this has been the peak. This was the peak of December. Then this was the high of March, high of July, high of, I think it was around October, end of October, November. Actually, December 1st was this peak right here. And just, it's interesting how much symmetry there is in price movement, and how it's just kind of, would fall and come right to that line, fall again to the line, fall again to the line. So I don't know if we can break through this and start doing the opposite thing, where we go up, come down to the line, go up, come down to the line. That's a really good shift into a bull market from where we've been in this bear market. So that's something I'm looking forward to seeing. We've still been a little bit mixed on the up and down signals. The blue is positive, the red is negative, but we're back into positive. Hopefully that can run for a while like it did back here, like it did there, and like it did there. We've got enough now where it may not be a fake out like we saw back in December and actually a little bit early November. But we'll see. We'll see. Yeah, optimistic. There's a lot of headwinds, a lot of momentum pushing in the right direction. For a change, it's been quite a while since we've seen this. And then finally, I want to look at something we do with market neutral. I did a whole, spent a lot of time on this early in the year, I think last summer. And that's just looking at the ratios between the S&P and NASDAQ or just ratios between two different indexes and saying, okay, we want to be long the strong one, we want to be in it, but then we want to be short betting against the weakest one. And the difference is what you make or lose, not what the market does, right? So if the market goes down 10%, but the difference between the two is really not that much, then the gain or loss is not as much, but it's a good way to be positioned for these bear markets. So we're still thinking about this going forward. And another thing interesting is QQQ is the NASDAQ and SPY is the S&P. When the NASDAQ is leading, that typically means the market is leading. And then, back here in March, that again, back to the last chart, March was a good run. The summer in July was a good run. Kind of had some November, although going into December, it was weak. And we could do it again. So we're set up for another little run where the NASDAQ is stronger than the S&P. That'd be tech, that'd be the growth names. And when growth is leading, then the market's going to go up. When value is leading, it tends to be a more stagnant sideways market. That's where we're at. I think I'd love to see this get stronger and flip to where growth is the leader, but that's where we're at right now. It looks promising. And don't forget, if you're on YouTube, to like and subscribe to this channel. Thank you very much. See you next time.